Welcome hustlers. In this video, we are going to discuss the art of growing money. This video is divided into 5 elements. The 5 elements are: first one is inflation. Secondly, you have to understand the power of compounding. After that, you have to understand the skill of growing money in short as well as long term. Finally, we need to comprehend the relationship between time, money, risk, and return. Let's start by talking about inflation. When prices of products and services increase because the drivers of inflation for a country are rising in cost of raw materials, wages, and increase in the money supply. India's inflation rose at an average of approximate 6% in the last 10 years. Let's understand with an example. Inflation is 7% and S has 100,000 in a savings account earning an annual interest rate of 4%. Each year, S loses 3,000 rupees to inflation. Buy power is impacted by inflation. The real value of money declines if it grows at a slower rate than inflation. You are losing money's worth if inflation is more than the earnings on your savings account. So, what can you do to beat inflation? You have to invest systematically. Let's talk about power of compounding. Compounding in layman's term is interest on interest. Compounding is the process in which an asset's earnings, from either capital gains or interest, are reinvested to generate additional earnings over time. This growth, calculated using exponential functions, occurs because the investment will generate earnings from both its initial principal and the accumulated earnings from preceding periods. In short, you will see exponential growth instead of additional growth in your asset. Compounding, therefore, differs from linear growth, where only the principal earns interest each period. We should discuss Rule of 72. According to Personal Finance Rule of 72, you can divide 72 by the interest rate to find the time it takes to double the money. It takes 6 years for your money to double if you get a 12% of the compounded annual rate of return. In this case, it takes 6 years to double the money at 12% interest rate. G invested 1 lakh 3 years ago. In the first year, get a 12% return. In the second year, get a 13% return. In the third year, get an 11% return. He compounded the money to 1,40,481. So CAGR, compound annual growth rate, is 12%. Let's understand the topic with an example. S and R both invest 1 lakh for 5 years. S gets a 6% per year of compound interest. R gets a 6.5% of simple interest per year. In this case, S generated a higher return. With the power of compounding, S generated 1,322 more. S generated 1,33,822 at 6% CAGR. Whereas R generated 1,32,500 at 6.5% of S. Let's see in another example. R and S invest 1 lakh at the same time. R gets a 16% return on his FD investment over 3 years, and S gets CAGR 6% on his investment. So according to you, who will get a higher return? S will get a higher return. With the power of compounding. Time and money. It is good to start early. With time and power of compounding, you can see a major growth in your assets. S needs a 50 lakh corpus for his retirement at age 62. He started at age 45, investing 5,000 every month. Yet his goal was not achieved. He must start early or delay his retirement. You have to understand the skill of growing money in short as well as long term. A destination is a goal. Therefore, it is challenging to arrive at a destination if the goal is unclear. A distinct separation between short-term and long-term objectives is necessary for effective planning. We examine the differences between these two terms to assist in making the distinction. The difference between a short-term goal and a long-term goal is the time it takes to accomplish each. Whilst a short-term goal can take days or weeks to accomplish, a long-term goal can take months or even years. The time here is relative. Here's an illustration. For instance, a company that has a long-term plan of doubling its sales revenue will start a short-term goal of intensifying its marketing strategy. The marketing campaign process might take several months, and it might take years to accomplish the double revenue goal. Therefore, the short-term goal period is relative to the duration of the long-term goal. A short-term goal is often a stepping stone that contributes to achieving a long-term goal. Short advice. For the short term, you must invest in FD/savings account because stocks have price volatility. Let's talk about risk and return. Let's understand it with an example. As we all know, shares have a larger risk than FDs, but if invested properly, shares may generate exponential returns on invested capital that are far higher than FDs. Why do stocks have a higher risk than FDs? Stock returns are not guaranteed, and they fluctuate, driven by market conditions/company's performance. Always remember, don't put all the eggs in one basket.